Well, stocks hitting record highs this week after the inflation data print out yesterday morning came in line with expectations, reigniting some of that optimism that we have seen on the street that we could see a rate cut before the end of the year. And taking a look at where things stand today, you've got the S&P holding on to positive territory, pushing further above that 5,300 level. You've got the the Dow, just below 40,000. We, of course, are going to monitor that and see whether or not we can reach that level. Here to tell us more on where the markets are headed, we want to bring in Kevin Gordon. He's Charles Schwab Director and Senior Investment Strategist, here to break it all down. So, Kevin, I'm curious, how are you looking at the levels that we're currently trading at and whether or not you do still see some room here to the upside?
I think there's room to the upside, but I think more important to keep in mind is what's going to get us there, number one, and then number two, kind of what to expect, and maybe paring back the expectation of really strong gains, akin to what we've seen if you go back to last October, when we really got this leg higher after that correction. And I say that because, so much focus this earnings season has been on companies, for the most part, at least for the S&P 500, different story down the cap spectrum, doing relatively well. But in our mind, when you look at the data and you look at the outperformance for companies relative to the S&P or whatever benchmark, even when they're beating earnings, there hasn't been outperformance. You've actually seen an average decline of 0.2%. So when you factor in sales and there's a beat on sales and earnings, that's when you've gotten strength. But when you start to look at where we are now in the earnings cycle, now you're moving back into double-digit territory in terms of earnings growth. That's actually a weaker zone. You're still seeing gains, but historically a weaker zone for the stock market. The strongest zone is when you're between down 20% and up 5% for earnings. So we've already exited that zone. Now we're just moving into something that's a little bit more, consistent with maybe relatively, less strong gains, I would say, but you're not in negative territory. So that's the one thing. The second thing being what you mentioned about rate cuts. I'm not sure that we should put so much emphasis or so much focus on the Fed cutting being necessarily a bullish or a bearish thing for the market. It really matters more as to why they're cutting, what the economic environment looks like, because, if they're cutting for the wrong reason with unemployment surging and the labor market deteriorating, that wouldn't be a risk-on scenario for the market.
And so you mentioned that even if companies are beating, they're still not being rewarded as much as we've seen in the past. So that would almost kind of spell out this hyper Goldilocks scenario that we could be navigating through for the rest of this year, even leading up to the election in November as well here.
Yeah.
How would you evaluate that? And what have we typically seen in those types of environments?
Well, I think it speaks to, what the focus has been on the part of the market where if you're beating on earnings and if you're achieving really strong earnings growth and in a profit scenario just based on aggressive cost cutting, that's just not good enough anymore for the market. So you're at the point in the cycle now where you need to start seeing actual sales growth and revenue growth improve, because we've been in an environment of decelerating revenue growth, still positive, but the change has been sort of moving lower. So as long as you start to see that improve in the back half of this year, which we would expect to be the case, then you can get another leg higher in the market. But you need to see both of those come into play in addition to strong guidance. That's another key area where we haven't seen as much strength on the part of the market's reaction as if a company's revising guidance to the downside. That's been to the detriment of the stock.